As many of you know, the main premise for my channel is to help you understand investing and make it easy for you. I've said before that when I worked in finance, one of the first things I've learned or picked up on is that investing can actually be very easy, but there is a lot of clutter, big words, and complicated tactics that people use as a way to take advantage of your lack of knowledge, and they make money off that. And that was one thing I realized, that it doesn't have to be as complicated as people make it out to be. That being said, you can still make mistakes, and I know I've made plenty of mistakes with investing. So today, I have for you 5 mistakes to avoid when you're starting to invest, especially in your 20s. Hey everyone, and thanks for joining me today. My name is Matt, and as I mentioned, today I'm going to give you 5 mistakes to avoid when you're investing. And I'm not really going to waste any time today, so we're just going to jump right into it. The first one I have for you is simply overthinking it. Now, I think most humans have the issue of overthinking things, and it doesn't even have to be investment related. Anytime people have to make a big decision, whether that be on the house they're going to buy, the car they're going to buy, where they're going to go to college, if they're going to leave their job or the job they're going to pick, a lot of us get stuck in the, as Bigger Pockets calls it frequently, analysis paralysis phase. And that's where you spend so much time thinking about something to make sure you ultimately end up making the right decision, but we'll end up just not making a decision at all, and we'll prolong things that could have been done weeks, months, or years ago. And it's very common because, again, you want to make sure you're doing the right thing for yourself, but one of the worst things you can do for yourself is not taking action. So the best tip I have here, or way to avoid this mistake, is by just do it and just get started. Now, I know with investing specifically, that can be easier said than done because there are a lot of things to take into consideration. You need to consider where you're going to open up your account, what kind of account you're going to open up, how much are you going to put in there, the investments that you have, and that all sounds really daunting, but there's a few easy ways to really get started. There's apps out there like Acorns that you can use that allows for you to invest spare change, and it automatically picks a portfolio for you. I might have a referral link for that, and if I do, I'll leave that in the section down below, the description down below, in case you want to use that and get started with Acorns. Or even, there's a lot of people out there with referral links for places like Robinhood that give you a free stock to get started. I have a referral link that is going to be down below. Other people have one, so you can use theirs if you like their channel also. I really don't care who you use, but I'd love it if you use mine so we can get some free stocks together. But the fact of the matter is that you got started. So whether it be using something like Acorns, where all you need is $5 to start and they pick the investments for you, or you use something like Robinhood to get a free stock and that's going to be your first investment that you have, all that matters is that you actually got started. The rest of that you can figure out as you go and start to learn more with the portfolio. And if you're really not comfortable with putting your money into the market before you have a great understanding on a lot of this, then start with paper trading, because at least that'll give you the full-on experience of what it's like to have money in the market. You see me do that every week with Watchlist Wednesday. Again, that's just paper trading, but it simulates the market and it's a way for you to learn how to invest. The next tip that I have is running before you can walk. Really, I see a lot more people that are trying to complete a triathlon before they can even crawl when it comes to investing. So really the best thing you can do here is take it slow. From this channel, I've been able to help a lot of people. And while I only have not a huge channel, I still love that I've been able to help people, especially with licensing exams. I've helped somebody pass the Series 7 as well as the real estate exam. And that's one of the main reasons why I love doing this. But with that, I get a lot of questions for people who want to use these advanced trading tactics, and they still don't really fully understand the core aspects of investing. Generally, these are going to be questions on things like options or margin accounts. Now, margin accounts isn't really something you could just walk right into because that's leverage. They want to know about your investing experience. So it's not an easy thing to get started with. But recently, options have become very accessible to a lot of investors. And I've said this before, but margin and options are in the top 5 reasons why people do not pass the Series 7. And it's because they're a very advanced trading tactic. And it's not really meant for your typical retail investor. I see a lot of channels on YouTube talk about options as if they are a easy, liquid, and just very basic way of trading, but unfortunately that is not the truth. When I was working in finance, one of my clients that I was helping one time was actually the hedge fund professor at NYU. And I just enjoyed talking to him because he was incredibly knowledgeable, and one of the questions I asked for him is, what do you think about options for your average retail investor? And his response, I thought, was actually kind of funny. He told me that options are a trick to stump Wall Street. That's why the options exchange is located in Chicago, not New York City. And I'm sure he said that with a little bit of humor, wasn't 100% serious about it, but it made sense to me. I think what he meant in a more serious context is that options just really are not for your average investor. It's a strategy that is used by hedge funds, typically as a way of mitigating risk or having speculative positions. But on a small scale for a retail investor, they typically just don't make sense. And that's why it's something that I don't usually talk about. Now, I have been getting more and more questions on options, so I'm considering doing a series so that way, if you're going to be stubborn and do them anyway, I can at least give you a little bit of knowledge. But the reason why I don't typically make videos or talk about options at all is because it's really not something you should be concerned with right now. It's a strategy that as you get more advanced, or if you have a lot of money to play around with, maybe you can consider. But for right now, there's nothing wrong with really sticking to buy and hold as long as you know what you're doing. And honestly, that's what I would stay with until you can tell me how a long call is a bullish position and a short put is also a bullish position. So I know that sounds weird, but those are kind of the basic terms you need to know before you invest your money in it. And again, you can always start with paper trading with that, so that way you're not using your money and you can actually see how complicated those can be. The third tip that I have is just not understanding diversification. You've heard me say before that you need to minimize the amount of overlap that you have between your investments, and that has to do with diversification. There are many ways people get confused with diversification, and this is one of the things that I experienced when I was working in finance. But the most common way people do not understand diversification is with ETFs and mutual funds. Just because you own Vanguard's 500 index, Fidelity's 500 index, and Schwab's 500 index does not mean you're diversified. Ultimately, those are mirror images of each other, just with a different brand name on it. And so if you have those and you think you're diversified because these are each different investments, what you'll want to do is take that a step further and look at the investments inside of those. Odds are they're probably very similar investments, might be a few stock positions that are different, but really what you'll see is the only difference is how they're weighted. So Vanguard might have more exposure to Apple than Fidelity, but Schwab might have more exposure to Microsoft than Vanguard. Other than that, though, you're still investing in the same companies. So the way you would diversify yourself is if you can have a 500 index, but then maybe also look for something like a real estate index, maybe a blue chip index, or even something like a target date fund. Now, of course, you probably will have some similar stocks between those investments, but they'll be following different indexes, and ultimately the majority of those stocks inside of those positions are going to be different, again, with the exception of just a handful that might be the same. Apple is an example there. Apple seems to be in every ETF, maybe not real estate, but other than that, odds are you probably will have a few funds that have Apple, and that's fine, just as long as you understand that the majority of the other stocks should be different between those ETFs. Another way that I've seen people confuse diversification is by spreading their accounts out across multiple different firms. Unfortunately, that is not diversification. That's what I call just giving yourself a headache. The firm itself that you're investing with does not play a role in your diversification. Again, the only thing that does play the role in your diversification is the actual investments that you have. Now, there's nothing wrong with having multiple accounts at different institutions. So if you have like a TD Ameritrade and a Robinhood account, there's nothing wrong with that. Just understand, if you own QQQ at both of those places, it's the same investment. So you're not diversified with having the same position at two separate firms. The fourth tip I have is not understanding your account types. Now, I'm aware that this is contradicting to tip number one, but bear with me here. At this point, I'm just going to assume that you've already gotten started and you've opened up your account, but now we need to know what that account is. This is important because retirement accounts have a special tax advantage that non-retirement accounts don't get to have. But that being said, there's also limits with how much you can put in, when you can take out the money, if your employer's matching, what kind of money it is. And I'm aware that this could all sound really complicated and daunting, especially if you're just getting started. The best advice that I would have for this though is if you open up an account but you really just don't know what you have, call the firm that is holding on to your account and just have them explain it to you. Ask them nicely. Don't be aggressive. Again, I used to work in a call center for finance, and the best people to help out were the nice ones. And so I don't care how dumb you might have think you sounded. I'm aware that this is not something everybody does on a daily basis. And so as long as you're nice to me about it, I will be more than happy to explain to you the account you have, the positions that you were holding on to, and what other options are available to you. But if you're one of those that comes in hot and heavy and gets frustrated because it's something you aren't an expert on immediately, then odds are you're not going to have the best conversation. So I'm sure if you work in a call center, you've experienced this before as well. But just bear in mind, nicely call the firm that you have your account with. Say, hey, this might sound really stupid, but I don't know what kind of account I have. Can you just explain that to me or connect me with somebody who can give me more information on this? Odds are they'll probably say, not a stupid question at all. Let's take a look here at what you have and we'll see how we can help out, make sure you have a good understanding with this. And then they'll take the conversation from there. You can also ask somebody that you know, hey, I have this account, what is it? If there's maybe a financial professional, but I like calling the firm instead just because the firm already has your information and you really shouldn't be sharing your finances with the people around you unless it's somebody you're comfortable with. Once you have a good understanding for the account types that you have, that'll really allow for you to maximize your investing strategy. And again, it'll help make sure that you're just not making small mistakes that could lead to huge penalties, like an early withdrawal from an IRA or even an excess contribution to an IRA. So that's why it's important, again, once you've gotten started, to then understand the account type that you have. And lastly, tip number 5 is investing with your emotions. This is a huge no-no when it comes to investing, but it's so easy to do. So what I have to say here is think back to March of this year, 2020. I know a lot of you out there were contemplating selling everything that you have because of the investment news that was circulating. And I really hope a lot of you did not sell, because as we saw, the market very quickly recovered. Unfortunately, people do react to dips like that in the market and do sell out of their positions at the low. And that is the exact opposite of buy low and sell high. But unfortunately, a lot of people use their fear of having these dips in their portfolio as an excuse to sell out of the positions. And especially too, if you're paying attention to news headlines, it can be really easy to let the news sway your emotions into your investment decisions, but you really just need to avoid that. And this doesn't only happen when it comes to drops in the market. There's also FOMO in the market. If you don't know FOMO, fear of missing out. And that happens more times than not too with investing. Think of Tesla recently has been on a roller coaster ride, just headed in a straight up direction. I guess like more of like a rocket ship. They've been heading up like a rocket ship. And a lot of people had FOMO kick in, fear of missing out, and are starting to buy into this stock, which could be potentially overvalued. So just because you hear of a lot of people running into a position, the news is all hyping it up, saying that this stock's going to $1 million in the next 3 weeks, that's not an excuse for you to start buying it, because it might not fit into your portfolio, or you could be buying it overpriced. So again, it doesn't only, or your emotions don't only happen when the market goes down. It happens a lot when it's going up too. And that's where it's important for you to know if something's overvalued, undervalued, or if this just fits well into your portfolio and if maybe paying a premium still works with your investment plan. The best tip I have here, a way to avoid this, is by having a price in mind for how much you would like to make. And this is if you don't have a set investment plan already. But if you're just buying stocks and you have kind of a plan with each position, what I suggest is have a dollar for how much money you'd like to make off this and how much you'd be willing to lose. So example here would be if you buy 10 shares of company A at $50, your total investment right now is $500. If company A goes up to $60 a share, you have now made a $100 gain for yourself, which might be okay with you, but you think it can go up higher. So what you can do is using limit orders, specifically a sell stop. I made a whole video on this too to explain this further if you're interested. But you can use these limit orders to say, if the price goes up, that's great. I want to keep my position. But if it goes below $60 a share, I want to do my best to lock in that $100 or as close to it as possible. A limit order will help you with this. Basically, it's just a systematic thing. You leave it open for 60 days. And if the price goes to $59, it triggers a sell order. But if it keeps going up and up and up, then that order could just expire. So again, that way you're not selling out of a position and missing out on future gains, but can lock in as much gains as you have. It's a really good way to, again, just keep the emotions out of it, because it allows for you to say, ooh, I might just wait a little bit longer, hoping this goes up. But if it drops, you don't have to be constantly watching the news saying, is this going down? Is this going up? Do I sell now? Just let the computers take care of that for you. And again, it's a great way to pull the emotions out of the investing. Also though, if you can't do that and you really just can't stomach market volatility, don't watch the news. Just turn it off. Delete your investing apps and stop looking at your accounts. If you're investing for something 5-10 years from now, whether that be just like a normal savings goal or retirement, you shouldn't be watching your account on a daily basis. And I know that's easier said than done as well. I know when the market's doing well, it's great to look at it and you start forming a habit of always looking at your account. But then when it goes down, you start thinking, oh, do I need to sell? Do I need to make changes? What do I need to do? And you start letting these news headlines sway your influence on your investing strategy. So again, if you're somebody who cannot take market dips, you just only want to see it go up and up and up, let's be honest here. It's unrealistic thinking that will always happen. But I know people just like to think that the market's always going to go up. And if you're one of those people and really hate that when it goes down, don't watch the news, don't watch your account. Just have trust that as long as you have like an ETF, 10 years from now, everything should be fine in theory. Can't guarantee it, but in theory, everything should be fine. So if you're an emotional investor, either hand your account over to an advisor and say, I can't do this, you do it for me, or just don't watch it. It's really as simple as that, but it's up to you to be able to determine if you can pull the emotions out of it or if you need somebody like an advisor to do that for you. So those are the 5 tips that I have for today. I hope that was helpful. Of course, I have way more than 5 tips, but just for sake of time, I didn't want to make this video incredibly long. If you want me to do a follow-up video to this, definitely let me know and I'll gladly give you as many other tips as you need to help make sure that you are a successful investor. Again, too, I made videos on limit orders. If that was something confusing, I'll try to link that down below so you can see that as well. And yeah, again, too, if you want to get started and you're looking for a referral link, I have the Robinhood and potentially the Acorns one in my description down below, so check that out as well. I guess I'll go ahead and wrap up there. So if you like this video, I just hope you consider giving it a thumbs up. Please leave a comment down below if you have any suggestions or anything I can do to maybe make these videos more enjoyable, or if you liked it, or if you have any questions, leave all that in a comment down below. And if you haven't already, I just ask that you consider subscribing. But I guess with all that said, you could be anywhere in the world, but you're right here with me, and I really appreciate that. So thank you so much for taking the time out of your day to watch this video, but I will let you go ahead and enjoy the rest of your day.